Good afternoon to all our participants. Thank you for joining today's Green Tick Dialogues on High Quality Financial Statements under IND AS, Auditor and Company's Perspective, Part 2, featuring Mr. Chandan Lahoti, Partner Ahuja Walecha and Associates LLP. Today's webinar is the second second session of our three-part webinar series. For all those who missed the first part, you'll be able to access it on TaxSutra Learning Hub. A brief introduction for our speaker. Mr. Chandan Lahoti is a partner with AVA Network and is responsible for corporate development and strategy within the group. Before this, he was with EY for 16 years and was servicing as director and specialized in statutory audits. He has worked on audit assurance engagement of large multinationals in India as well as overseas. As a part of EY, he has led and managed audit of large listed entities, including the likes of Cummins India, Bharat Forge, Atlas Copco, Eaton, etc. He has worked in diverse industries, right from heavy engineering, automotive, information technology, and startups. He likes mentoring fresh qualified CA. He has also been an active speaker on various topics at EY India level and ICI at different forums. We welcome you, sir, for the session. Before we dive into today's session, everybody, for all the participants, the last 10 minutes are dedicated for Q&A session. Please feel free to post all your queries on the Zoom Q&A box. And without further ado, let me hand it over to Mr. Chandan Lahoti.
Thanks, Surbi. Thanks for such kind words. And thanks to all the participants who have joined for today's webinar. And really, it was nice to complete the first webinar where we had discussed on a lot of IND AS related issues. Just for the ones who have joined it for this session as against the earlier one, because as Surbi mentioned, we would be doing total 3 sessions. And in 3 sessions, the intention is to cover all the IND AS. Okay, so what we did in the first session that we covered five or six IND AS. Today we are planning to cover more 7 odd IND AS, and balance will cover in third session. To just give a brief about what exactly we would be covering, so that everyone is aware, and then we accordingly discuss. So first of all, definitely not necessary that the Q&A would happen only at the last for last 10 minutes. We'll continue our Q&A throughout the session, because we would be deep diving on all the IND AS and all the IND AS related all the issues. So what I have done in these 3 presentations, there are several errors what I've observed in a lot of IND AS financials over last 7-8 years when IND AS has come in India. Some basic issues in the financial statement with regard to disclosure, with regard to measurement, and with regard to various other compliance related matters in this IND AS financial statement. So thought of just compiling and putting forward some of the IND AS, some of the issues which are very basic. So if there are many more, but to start with, for all of us, we need to just ensure that the first level of compliance at a basic level need to happen. So that was an intention. Today, we would be covering all these IND AS. If time permits, we'll go till 40. Otherwise, my intention is to cover till 33, bare minimum. Before we go into exact discussion about IND AS 16, I would just ask everyone, if you have attended the first session, and with regard to those IND AS which we covered in the first session, if you have any other issues, matters which you want us to discuss, we can discuss those points. So, Savit, you can't hear? I see a chat from Savit that he can't hear. Savit, is it clear now? Anjur?
Yes, it is right now. We were able to hear you.
Yeah, it was very clear.
Others can just put on the chat box if you can hear me properly, because one of the participants could not hear. Others can put on the chat box if you have any issue in hearing. I think so, Anjur and Surbi. Okay, now it's audible. It's audible. Okay, great. Thanks for confirmation. All of you who have confirmed that you could hear. If you have any questions on any of the index which we discussed that day, if not, then an expectation would be, as there might be many people who have joined from industry, many people who have joined from CA practice, CA firms, etc. If you can put on your chat box only three things uh, broadly. If you're working in industry or you're working in a CA firm. Second, you have a good index knowledge, average index knowledge, or you're fresher from an index perspective. And third, uh, any specific expectations, if any, from the session, so that I can understand the audience better, and accordingly I would tailor made my discussion for next 60 70 minutes. Industry, average index knowledge, CA firm, yes, CA firm, good industry. I could see 7 8 messages as of now. Nice. Okay. I'll wait for 10 to 20 more seconds so that we can understand, I can understand the audience better. Accordingly, we will discuss again. Good, I could see few of you are from industry, because accordingly, we know we need to focus more as an auditor or more as a corporate person. Okay, great. Thanks. That definitely helps me. What we'll do, we'll directly go to the next index number 16, wherein, uh, okay, to brief you how we will discuss. So what I've done, I've taken an index, and with regard to that index, a specific issue which is observed in the financial statement. What is that issue? How it should be dealt with? Why it is an issue, and how it need to be tackled. That is the concept what we will follow. So if you see here, in case of fixed assets, when fixed assets are capitalized, at times subsequent expenditures is incurred. Okay. And if subsequent expenditure is incurred, which is capital in nature, whether those amounts are allowed to be capitalized under Ind AS, yes or no? I want few Q&A. I want some comments in Q&A whether uh, if a subsequent cost is incurred, but it doesn't enhance the life of an asset, still you can capitalize or you can't capitalize. Yeah, so we would be only focusing on deviations found in actual financials. Okay, Geet is saying it should be expensed out. Anil, can you repeat? Is it yes means should be capitalized, should not be capitalized? Okay, Rajesh is saying it should be capitalized. Yes, we can capitalize. Anyone else have any other? Okay, great. We have few answers. It does not add a value. It should not be capitalized. So, what does value mean? Okay, so very clear. One need to understand. Subsequent amounts can be capitalized even if there is no increase in future benefit from an existing asset beyond previously assessed standard of performance. What does that mean? For example, there is an asset capitalized 100 rupees. Subsequently, if there is some addition to that fixed assets, which is capital in nature, you can still capitalize that as a subsequent cost, and which is allowed even if the cost which is incurred subsequently doesn't further enhance from the previously asset standard of performance. That means it should be a cost which is incurred for capital in nature, which keeps the life intact. And this is very important because a lot of financials we see this issue and a lot of expenses which is being expensed out. Yes, if it fulfill the IND AS 16 conditions. Should we capitalize only if it increases performance? Anil, that is not mentioned in AS 16 specifically. It clearly says that it can be capitalized if it's capital in nature and AS 16 is satisfied. It doesn't say further enhanced. If it's further enhanced, then the life might also increase and then life need to be reassessed. It's about subsequent cost recognition we are saying. Any questions here? Feel free to ask. We can discuss on the specific points because a lot of people have doubt and a lot of people believe that this is particularly an issue and they charge it to P&L, which should not be the case. The next matter is from an disclosure perspective. I think so. Most of you might be aware that few years back, when there was a change in Schedule 2, Schedule 3, both, it was clearly mentioned that in case of a fixed assets and a CV, a movement need to be given as part of the disclosure in IND AS. However, still I see many financials where CVIP related movements is not captured. PPNE related movement is still given in most of the financials, but CVIP related disclosure is not given. And it could be observed clearly in the financial statement that if an opening CVP is 10 lakhs rupees, closing is either 12 or 8 lakhs, there is a movement. That need to be clearly, this details need to be given. This is from a disclosure stand perspective. Yes, Savit, you're going back. Savit has the call. Yes, that means it brings the asset to its original capacity. Your understanding is correct. If any question on this, yeah, very simple, but found in most of the financials. I thought of highlighting it so that the ones who attend this session minimum doesn't have this issue from auditor's perspective or from a client's perspective next time when they prepare the financial statement. This next point is very much important and valid. It's with its regard to property, plant and equipment such as leasehold improvements. If there is a leasehold improvement and an asset is capitalized, how it need to be amortized? Should be amortized over the primary period of lease or the useful life of respective different assets in the leasehold improvement, or whichever is shorter. Some comments and answers I'll appreciate. You can put your views on chat box. Okay, Chairman says whichever is lower. Someone says useful life period or useful life whichever is shorter. Okay. Mhm. So if you see clearly, providing a depreciation on leasehold improvement, lease term should have been considered instead of considering primary period of lease. This is about a basic expectation. However, if the lease period is for 10 years, okay, and the life of those assets in the leasehold improvement is lesser, still the leasehold improvement would be depreciated over the lease period because the company would be using that leasehold for 10 years and the new assets which would be purchased has a separate asset in itself. There is no correlation between a leasehold improvement and those assets. We are talking about a leasehold improvement, and all the leasehold improvement, all assets are capitalized in one bucket. There might be furniture, fixture, etc. They has their separate useful life and need to be assessed separately. Any questions here? Is it clear? Some comments will help me get a comfort that you have understood, not understood. We need to deep dive, discuss on this further. Okay, I could see one or two comments. Okay, there are few points in a few of the Q&A. When part replacement is done and capitalized, but originally capitalized is for whole value. Yes. So Shiv Kumar, that's a different point, but I will clarify. That's a component accounting. There's a concept of component accounting in IND AS 16, wherein there is an asset, one of the part specifically mentioned in IND AS as a component, which is a significant component. Nowhere it is mentioned what is the percent, but generally under various literature, it is a 20% value of that component as compared to the fixed assets, if any, that need to be assessed separately. Now, tricky, please listen carefully. 100 rupees asset, 30 rupees of component, purchased new, fitting in the fixed assets, 100 rupees fixed assets, 30 capitalized. You need to remove that components value in original asset, be it 18, 20, 25 from the fixed assets. That is mandatorily need to be done. Hope you're understanding. It might be complicated. We can wait, discuss. But Shiv Kumar, hope I have answered you and you got clarifications. Others, if you have any doubt on this, what we discussed, I can elaborate further. But this is very important, applicable for most of the companies. Few of the answers are yes, we have understood. If not, put in the chat box, you are not understood. Okay. One more question was on useful life or a primary period. I think so, Shiv Kumar, that is being answered. Shiv Kumar, if possible, you can put those items in the chat box next time, because I am looking on the chat box and uh, uh, just clarifying all the doubts on the chat box. Thank you. Next, accounting policy with regard to PP&E. So, in this current case, what has happened? Company has recognized several costs in CWIP for the project accounting. Okay. Now the question is whether all those expenses which is incurred should be put in CWIP. We are not discussing about capitalization. We are discussing about the expense incurred, whether in P&L or whether in CWIP. Can someone give some views till what date assets, till what date the expenses incurred should be capitalized? Because at times I've observed that expenses are incurred even after ready to use. Expenses are incurred even before the assets was even started. And here the most important, I want you to understand, which is very, very important, is taken the most important part here is the difference between put to use and ready to use. How many of you know what is put to use and what is ready to use? Yes says till it is ready to put to use. No, yes. Ready to use is a different concept, put to use is a different concept. And I want to discuss about ready to use and put to use as a concept. If you are aware, let me know. Ready to use is fully operational but not yet put into commercial production. Depreciation will start off. We are not discussing depreciation when it will start. We are asking about till what point of time the expenses to be capitalized. Okay. And as per IND AS, expenses can be capitalized until ready to use or until put to use. And where does put to use concept come from if it's not written in IND AS? Capitalize until put to use is what Geet says. Geet, we will discuss that in detail, but it's not till put to use. We'll discuss. Okay. So what we'll do, there is one more question later where I will discuss that in detail and what's the difference and how, as a company, as an auditor, you need to keep in mind. But limitedly on this point, recognition of cost in the carrying value of PP&E ceases when an item is in the location in the condition necessary for its capable for operating in the manner intended by management. In simple terms, in that location, if asset can be used as intended. However, few of the expenses which should not be capitalized, such as uh, cost incurred while an item capable of operating in a manner intended by has not been bought to use. So, for example, there might be few expenses which are expenses incurred, uh, even though that's not full capacity. It can be under capacity. There can be operating losses. Many companies does in capitalize operating losses, which should not be the case. Reallocating, reorganizing the assets, all those expenses should not be capitalized in any case. I'm just reading out some of the questions. If any of the questions is not answered, I hope all these questions are answered. If not, you can put on the chat box again. Okay, we'll go to the next index. We'll come back on put to use and ready to use difference and the importance and the logic in next 3-4 questions because I will correlate there properly. Okay, very important. From now we are in days 19 from a gratuity perspective. Just few Q&As or poll type. Yeah. Tell me from a gratuity applicability perspective, because I am surprised to see uh, most of the companies or auditors are not aware about the applicability of gratuity. Can you put on the chat box when is gratuity applicable for a company mandatory? Accounting, non-accounting is different. Anyone? Which type of companies when gratuity accounting is mandatory? Point one. Point two, if it's mandatory, whether an actual report is required to be taken in each case, yes and no. Anyone? Okay. So one or two of you have correctly answered. Gratuity Act is applicable for any proprietor, partnership, or private limited company if there are more than 10 employees in the company. Okay. I have not mentioned, I have just mentioned proprietary, private limited, and LLC. However, post 2000 17. Just hear me out. For public limited companies, listed companies, subsidiary of a listed companies, etc., it's a mandatory irrespective. Okay, there then headcount, etc., employees is not covered. Point one. Second, some of you said gratuity is applicable after 5 years. Some are saying employee need to complete 5 years with the current employer. Some are saying actually report depends. Yes, Harshvardhan, you are bang on. But on the second part, actual report depends on level 1, level 2 of the company. SMC, non-SMC is the terms used. Level 1, level 2 are the terms used. And accordingly, actual report is required. Savita, wherever gratuity is applicable, actual valuation is necessary, not mandatory. So there is a difference between gratuity applicability. There is a difference between actuarial valuation. Okay. So for example, there are cases where gratuity is applicable, provision is required, but not mandatory. You go to actuary. You can do it on an assumptions by yourself and provide for on very few limited cases. Okay, that's point one of discussion. Point two, for few of you, we have seen many companies, individuals, proprietors, and you audit individuals, proprietors, private limited companies. Gratuity provision need to be done irrespective of the number of employees who has completed 5 years. If there are no, even in year one of a company, gratuity provision need to be done. That's point one. Point number two, which is very important, is how to disclose gratuity. So as per IND AS 19, disclosure depends basis whether it's an SMC or non-SMC, level 1, level 2, as the case may be. However, ideally, if a company is an IND AS company, that company getting classified as SMC, non-SMC is very rare, or I have not seen. So in ideal scenario, we'll assume that it's a full-blown company and all the gratuity related disclosures need to be done. If it's IGAP, answer would have been different. Is it whether gratuity applicable actually valuation is necessary? Not necessary if it's an small company where it can be done on an actual basis. Okay. Yeah, Harshit, it's not mandatory for all, but actual report to be taken for employees more than 10. No, gratuity is applicable for proprietary LLP and private limited companies. Employees are more than 10. Taking an actuarial report is a different section in AS 15 and in AS 19, and gratuity provision comes from a gratuity act, and actuarial valuation comes from IND AS and accounting standard. Yes, correct, Shiv Kumar. Hope clear. If any questions, you can put on the chat box. The next is very important, and I see a lot of financials where this issue has occurred. There is a company who has declared VRS, and expenditure on VRS is incurred, is debited to P&L as and when incurred. Is that correct or incorrect? Correct or incorrect? VRS expenses need to be disclosed when it's incurred or something else. Rajesh says it's correct. Others, I need 5 answers minimum. Mukesh says incorrect. Mukesh, can you type what exactly it need to be? And on accrual basis, that's a basic accounting funda. Specified. Subankar says incurred. Okay. Sukumar, Savit, you are somewhere correct. VRS expenses need to be accounted in the financials when all the terms and conditions are fulfilled and company doesn't have a choice to go back from the policy and the employees has accepted, etc. So in VRS, explaining the concept, there is a policy which is rolled out. Employee has a time period to opt for. Once it's opted for, management has a time to accept. Once management accepts, the payment might happen over next 1 year, 2 year, 3 year, 5 year, as the case may be basis the policy. But expense is incurred, accounted for on the same day when there is no chance to management to take the policy back. However, and most important, accounting of that VRS expenses need to be discounted if the payment would be done more than 1 year. Is that fine? Okay, great. Very important. Next point. Uh, Director sitting fee was disclosed under the note other expenses. Is it correct? Incorrect? And I would say 80% of the financial this is incorrect. I could say only Rajiv, Mukesh, Anil, Shubhankar, Shivkumar, Savi. I want to name them because they are the only ones who are putting on chat box. Others, just write out, test your skills. Let's discuss. Harshavardhan, your point is correct, but I let me wait for others to put their no, Savit, the discussion is whether director sitting fees need to be disclosed in other expenses or some other schedule. Uh, Payment to directors is not a schedule in India's financial statement. Okay. Okay. So I'll just go to an answer and we can discuss Harshit on this. It need to be disclosed under employee cost. Harshit, why do you believe it's a very harsh statement? I'll just explain my point of view and then you can tell why you believe it's harsh. So employee cost, including director remuneration, director sitting fee, because director is a, so there are two types of directors, full-time director, working directors, or independent director. So in every case where uh, remuneration or the director sitting fee or anything which is paid to a director uh, uh, in every case it need to be disclosed under employee benefit because director himself is an employee who is an whole-time director and director, and anything which is paid to him should be shown in employee benefit cost, and the expenses which are incurred and paid for a independent director sitting fee, it should go in a director sitting fee. Hope that is okay. Is it audible? Can everyone can listen to me clearly? Anil, the sitting fee is paid to whole-time directors also because you would see many times they get sitting fee, they get HRA, they get various other perquisites, benefits, etc. So accordingly, this is being disclosed. But hope it is fine. Okay, great. Okay. Now, with regard to an employee benefits, actual gain and losses should be disclosed or charged to the P&L directly? Yes or no? How about non-executive directors? Then non-executive directors will not go in employee benefit. Very slow. I am not getting any answers. Actual gain and loss should be disclosed in P&L or charged to P&L? Yes or no? Rajesh Konda says both to OCI and P&L. Yeah, we are discussing under IND AS. So, Rajesh, actual gain and loss uh, are so. I'll just tell. So, actual gain and loss, which is calculated uh, by the actuary, are basis the assumptions what would change in future years. Okay, and accordingly, it need to be disclosed in OCI because those are the items which are disclosed in A because it's about deferment. It's not about the cost which is incurred for the current year. And that is basis the future year what is expected. In this current case, also a lot of disclosures with regard to IND AS 19, there were issued. Harshit, gratuity is defined benefit obligation and accordingly it is shown in OCI. We are not discussing leave encashment or PF, etc. Gratuity is a defined benefit obligation and the actual valuation difference for gratuity need to be disclosed in OCI. Okay, great. The next one, and before that, I have some uh, very important things to discuss. Yeah. Before going to the next point, I want to discuss about few questions. Can some of you put on the chat box whether for gratuity, measurement and valuation by the actuary report and what is disclosed in financial, is it different or same? Okay, so put it question differently to understand. So what I've observed in an actuary report, actuary gives few details. This is current, non-current. Correct? Basis the actuary report of the current and non-current, those numbers need to be disclosed as a current, non-current in the financial statement as current and non-current or something else. Hope the question is understood. And here, I would request others also who are fresher to participate because this is very important, common error found in most of the financials. I want some answers. And if you have not seen actuary report, just assume actuary does valuation and they give what is the current portion, what is non-current portion. As is those amounts which is disclosed in an actual report as current and non-current to be disclosed in the financial statement or something else. Yes, it should be as per actual report. If it's been already created, occasion will adjust that's fine. Okay. Again, I will repeat the question. In an actuary report, there is an amount of 100 rupees as a gratuity provision. It gives 50 as current, 50 as non-current. Those as is 50 non-current and as is 50 current, you would show in the financial statement or something else. We are not discussing about 100 rupees. 100 rupees in actual reports, your financials will 100 rupees. We are discussing about current, non-current bifurcation. All the answers what I've got is incorrect. And I'll explain the concept and then we discuss further. So let's go to the auditing standards now. Everyone is aware what is measurement and what is valuation, or I would say this valuation, and disclosure. Everyone understands assertions? If not, there are two different assertions we will discuss. First assertion is a disclosure. A second assertion is valuation. What does valuer do? He do working for the valuation assertion or a disclosure assertion? Huh? Shahu, Mukesh, Harshit, Sharad. Whether valuer is expected to provide the actual valuation report for valuation assertion or for disclosure assertion. Shivkumar, Harshit, Saud, Vaibhav, Ashish, Sharad, you all are correct. Harshvardhan, it's not both. It's only valuation. What does they do? From a valuation perspective, they disclose this is the total amount, this is current and non-current. However, in the financial statement, you need to disclose from a disclosure point of view. And when you do it from disclosure point of view, you need to keep in mind financial liability and current financial liability and non-current financial liability in place. And current financial liability and non-current financial liability is not as per management, what management believes someone has mentioned. That's the difference between the financial asset and a financial liability. A financial asset is an asset where current and non-current bifurcation is done basis management expectation. But for the financial liability, it is done basis terms of the contract, terms of an agreement. In current case and in a gratuity, if it's not funded, 100% amount goes to non-current because it would be paid in the future year. However, if it's a funded, listen carefully, if it's funded, then the next 1 year expected contribution as per actuary report or as per management or as an LIC report need to be disclosed as current, all other as non-current. And not as per actuary report. If till date you are doing as per an actuary report, it was incorrect. Savit, I have not seen any report till date. If you have asked them and if they have done it, very good. But I have not seen any report where actually writes this amount current non-current is for valuation. This amount current non-current is for disclosure in financial statement. Yeah, I have not seen. If you have got it, then it's fine. Yeah, but hope you have understood the difference. And I want some yes or no. Sahu, Vaibhav, Sharad, Sabit. Is it clear or clear? Very important. We can wait. Our intention for next, or we have more 20-25 minutes. Our intention is to ensure that whatever we discuss today, you absorb and apply in your practical life. I could see only 3 yes. Great. I could see 7, 8 yes. In current scenario, this was not the question. I thought let's discuss here. And similarly, guys, leave encashment. Leave encashment, current, non-current, as per actuary report and as per financial is different. Okay, as per actuary report, every time they give a bifurcation of 100 into current, non-current with some amount. But in financial statement, 99.99% leave encashment would be, I want answers from you. Leave encashment would be current or non-current? Ashish Mehta says current, but in actuary report they give current and non-current. Then why you show current? Question to you guys. But here, yes, Rinkin, you are exactly bang on. But have you understood that in an actuary report they gives current non-current details for leave encashment? but still in the financial statement you disclose only current. No, for gratuity it's not same, and I will give the reason behind it. For leave encashment, as per 99.99% company's policy, employee has a right, employee has a right to take the leaves fully in the current year, and there is no restriction on availing the leaves which is available in their balance. However, there are very few companies wherein they restrict to avail and a cap on the uh, cap on availing the leaves. In that case, that portion of which is not allowed to be availed in the current year is allowed to disclose a non-current, all other in current. Hope it's clear for leave, and we'll come back on gratuity. On gratuity, it's nothing to do with allowed, not allowed. It is when employee will leave, when employee will complete 5 years, and hence it's always non-current, because the financial statements are prepared on the basis that the employees would continue. If you have some records where employees left, etc., etc., those can be factored, but those are also non-subsequent event, not adjusting. Yes, Savit, except a certain portion, not all leaves are allowed to be carried forward. Yes, there it need to be disclosed that only limited portion as non-current, all other as current. Is it clear? Now coming back here, I thought of first discussing about gratuity leave encashment, which is applicable for all our companies. Here, what has happened in the current financial statement, current issue, a company has given long service award to its employees. Whether an actuarial report is required for long service award, yes or no, is a question. Yes or no? The actuary report is required, not required for long service award. There are 5 employees who are given long service award. Amount is calculated, etc. Service says no. Harshit says if non-funded gratuity is there, then the provision should be showing in non-current. Yes, Harshit, you are correct. Service says no. Ashish says no. Pramod says no. Shivkumar says yes. Shivkumar, your answer is correct. All long service contract requires actuary report, because you can't predict whether that employee or person will continue or not. Even if it's a one case, etc., you need to do it. Here it's a maternity call by the auditor and a company. If the total quantum of the leave, what need of the long service award, if it's not material, you can ignore actuarial report, but otherwise it's a mandatory, it's an actuarial report. And I'll give you logic and reason. Actuarial report is required not for gratuity or leave or something else written in standard. They write actuarial report is required for long-term employee benefit, and a actuarial report is not required for short-term employee benefit. Long service award gets classified as long-term employee benefits. That's the logic and the reason. Any questions? Because here everyone was incorrect in the chat box except Shiv Kumar. Thanks, Shiv Kumar, for correct answer. Okay. We are going to the next standard now. This is with regard to Forex. With regard to Forex, I'll just explain the matter. In the current scenario, a company has a subsidiary or a foreign option operation, as the case may be. In this scenario, if it's the case, an FCTR need to be accounted for. Everyone understands what's FCTR? Foreign currency translation reserve. Whether that foreign currency transfer, so that's the first point of the matter. The second point of the matter is when that, okay, before that, FCTR need to be created. FCTR need to be created and taken to OCI and not to the PNL. Second part. The third part, whether that FCTR which is generated and kept in OCI, when it need to be flushed back to PNL, whether on repayment of the monetary item or any different point of time. If you have understood question, put on the chat box your answers. If not, please put we have not understood question and we can discuss. Because I want conceptual clarity to all of you rather just on this particular point. One of you have answered. Let me see others. Pramod says not understood. Pramod, first, just clarify where you have not understood. Pramod, in every company, when you have foreign operations or a subsidiary, at the year end, due to foreign exchange, there is a foreign currency translation reserve which is created. Whether that foreign currency reserves need to be accounted in OCI or PNL first, answer is OCI. Point number two, when it need to be flushed from OCI to PNL, when it is repayment is done or some other time. Someone says amount get due payable. Savit, that's not the correct answer. It's not when amount becomes due and payable. When amounts get due and payable, you pay, but you don't flush FCTR on those transactions to PNL. Okay. In the current case, difference in forex is calculated and recorded in FCTR under OCI. That's the first point, because here it's not written FCTR. FCTR is recorded in OCI and it is always done on the repayment and not against. This is very, very important. And one need to understand the difference between the disposal and the repayment. There is a difference between disposal and repayment. Hope it's understood. Yes, it's being tricky because one need to understand when it's FCTR created, when it's generated, when it should be flushed, etc. But important part is to understand it. It need to be done only in at time when the disposal is done and not repayment. So with this, okay. So payment means these are monetary items. There might be transaction between two parties, purchase, sales, or various other items. You might invest further additional investment in a subsidiary, additional money given to branch office, purchase sales transactions in branch office, uh, partial selling of the shares, dividend, etc., etc. So, however, the FCTR is not flushed from that OCI to PNL when the repayments are done or when the transactions are done. It is done only when the investment disposal is done. And this is very important. And it has a big chunk in every financial statement. If you have any point, we can discuss. Otherwise, I'm just going for next slides. We might, uh, we will complete in next 10 to 15 minutes some of the other matters which I have put in the next slides. If still you have any doubt on an FCTR OCI, you can put on the chat box. Okay. Great. Now let's come back to put to use and ready to use. Some of you answered there and I'll just explain the concept, and then I think so we can take it ahead. So under IND AS, there's a concept of ready to use. All assets are capitalized when it's ready to use under IND AS. However, under income tax, there is a concept of put to use. Most of the scenarios, the ready to use and put to use is different, other than computer, where it is a possibility that there can be a difference between ready to use, put to use, but otherwise, there is some small time lag, big time lag between a ready to use, put to use. Normally, when factories are made, factories are ready, but the operation starts at a later date. And hence, always there is a difference between an income tax and the books amount what need to be capitalized. Under section 36(1)(3) under Income Tax Act, which need to be reported under tax audit. There that differential amount will come because what happens, a borrowing cost incurred and capitalized in financial statement includes only till ready to use, but for the income tax purpose, it need to be put to use. So hence the amounts are different. So the question here is, in the financial statement, it is disclosed as put to use various cases or disclose. So here, if you see here specifically, just highlight through. You could see up to the date is put to use. This word itself is incorrect. In the financial statement, it should be ready to use. Under income tax, you use put to use. Is it clear? Okay. Somehow no questions on this particular point. Okay, this is very simple. Leasehold land was shown under tangible assets, having same amount in the current period as well as the comparative period. Answer is very simple. Leasehold improvement need to be amortized over the life of the lease. In short, depreciation, what we call, or amortization need to be done. It was not done because both the years financials amount showing leasehold improvement as same amount, which is not possible. Small portion should go to P&L, nothing else. I think so. Very simple. Okay. Now we are going to the next standard, which is with regard to related party disclosure. Here also nothing great. What had happened? Company had disclosed related party transaction in an holding company financials. Corporate guarantee was shown. However, in the subsidiary financials, the details of that borrowing, no guarantee commission was disclosed, nothing was disclosed in related party, etc. So in short, under IND AS, if a parent company has given a guarantee to the subsidiary, from a subsidiary point of view, that guarantee received need to be disclosed in RPT. Commission need to be accounted for, that is mandatory. If commission is not accounted as a pure transaction between two parties, India says you need to do a fair value accounting and you need to account for that. And various other disclosures were missing in current case. Very important point. In the financial statement, there was a note which stated a waiver was given for the interest to be receivable by the related party. No more disclosures were in the financial statement, and same was disclosed in an exceptional item. Nature of expenses were also not clear. So few of the errors what was there. First, the interest receivable was from related party, which was waived off. Complete disclosure was required in the financial statement, which was not done. Further, it was classified as an exception item. However, as per para 97 and 98, there are specific items which has been mentioned what can be disclosed as exceptional and what should not be. In current case, it's not allowed uh, to be disclosed as an exception item. That's an error. I can just put on the chat box. If you're aware that very rare items are allowed to be shown as an exception items. Otherwise, we see in many financials, many items are considered as an exception items, which is not allowed. And these were disclosure related issues. I will take minimum 2 to 3 minutes for this particular point, and which is very important. Like gratuity and leave encashment, we discussed about current, non-current. I could see many financials and many professionals having still doubt about what is financial asset and what is non-financial asset. Can you put, I want few comments in the chat box to explain what is financial assets and what is non-financial assets. Is interest accrued a financial asset or a non-financial asset? Okay. Prepaid expenses, balance with government authority, financial asset, non-financial asset. I don't want definition. Someone putting a definition, any convertible into cash and bank in financial asset, that's fine. One could say balance with revenue authority, we will get money. That means it's a financial asset. Let's debate on simple items like GST balance, income tax balance. We will get in cash. Is it financial asset, non-financial asset? Government balance with GST, balance with customs, financial, non-financial. About non-financial, but why? Some explanations why non-financial. Non-financial asset as coming by law. What does law mean? No, not necessary. Every statutory balances are non-financial. There can be many items which are from government, can be financial items. Someone says balance with government authorities are financial. Shiv Kumar, most of the balance with government authorities are non-financial. Okay, someone says it doesn't arise by financing activity. My friend, answer is wrong. Nothing to do with financing activity. Shivkumar, even if you can seek refund, it's still a non-financial because there is no contractual obligation between you and the government for them to pay. You have paid extra and hence you're asking for it or you're claiming for it. It's non-financial asset. Shalu says no definite period. Period is nothing to do with it. There are financial assets which are non-current. So very clear. I think so. We discussed a lot about financial, non-financial, but please understand uh, it's about understanding the transaction and evaluating whether there is a contract, there is something what you would be getting. If there is no contract, if there is nothing that we will get it, then yes. So for example, I will tell there might be companies who does dealing with government authorities. Their money to be received is financial asset. So it's nothing to do with government, statutory, etc. You need to understand on each transactions. Again, in few cases, refunds can be classified as a financial asset. I'll, and I'll give few of the examples like MEIS, MSIPs were shown as a financial assets in the financial statement because they were contractually obligation to be done. Okay. Rotep scheme could be evaluated for financial, non-financial. Okay, very simple. Next point, we can take it fast. Simple. Whenever in the consolidated financial statement, if there is a subsidiary and JV, you need to disclose the place of operations. You would see a name of an entity is given, but whether it's in India, US, UK, etc., not given. That's important. And proportion in the ownership interest, 100%, 80%, 90%, as the case may be, which is missing in the current disclosure. Again, simple point to disclose, but important. Okay. Is there difference between the weighted, whether the number would change if an weighted average is done on the closing shares or weighted average is done for throughout the year shares? I will repeat again. For calculation of EPS, there are opening shares, there are transactions during the year, and there are closing balances. Companies calculate weighted average basis opening, additions, closing, which is incorrect. EPS working need to be done on closing shares with current year addition deletion. That means, for example, there was 100 shares, 10 shares were added, 20 were reduced. What would be the balance? 90. So 20 which is reduced, they go out. So 100 for 365 days, 10 for half days, and then the weighted average. There is a huge difference between weighted average of a closing and the weighted average of addition, deletion, etc. And these are errors being found in several financials. Second, calculation of EPS is done on PBT, PAT, as the case may be, many different things. No. Profit attributable to the shareholder, which includes OCI. And third, definitely several disclosures which is required by EPS standards on various items were missing. Any questions here we can discuss? Simple, but very important. Errors in the biggest of listed companies, I have seen this. Bonus issue given in the current year. Hear me out. Bonus issue given in the current year. Adjusted EPS correctly calculated, factoring the bonus issue. Whether that bonus issue which is issued now need to be revisited and the EPS for the last year need to be changed or not. Yes or no? Most of the companies doesn't change last year EPS. Last year EPS under IND AS also need to be changed and need to be factored. Good. That was the last time for the day. However, if you have any questions for any of the IND AS which we discussed earlier in session 1 or in session 2, we can discuss and let me know if any answers, any questions which you have put and I have not answered. Let me know and I will try to answer all of them.
So there are a couple of questions. Mr. Harshavardhan, he asked, can you elaborate on the applicability of gratuity irrespective of 10 employees or not?
Okay, that's fine. So in case of proprietor, partnership, and private limited companies, gratuity law is applicable if company, private limited company, proprietary, and firm has more than 10 employees. However, if there is a listed company, subsidiary of a listed company, equity, non-equity, etc., the headcount of 10, etc., is not applicable. Hope it's answered. If not, you can put again the question, the added top-up question, and I'll answer.
Yes, sir. Another question.
Savit, on your question, it's not existed on last year. Bonus issues are given in the current year. However, those both, in case there were not existence of previous year, it was not there. Bonus issue was given in the current year. However, bonus issues are given on the shares which was in earlier year. And in specifically, in the standard, it is written if a bonus issue is given in the current year, all those years disclosure from an EPS need to be restated. That's specifically written in standard. Nara, yes, you would get presentation. Yeah, you can send an email to either me, either someone from Tax Sutra. You will get the presentation. That's not an issue.
Yes. Sir, we have one more question from Mr. Shiv Kumar Ji. When part replacement is done and capitalized, but original capitalization is for the whole, how to decapitalize the part replaced?
Hold on, I need to read it out. When part replacement is done and capitalized, but original capitalization for the whole, how to decapitalize the part, you need to get two things from an initial invoice. If that part details are available, then you find that amount and exactly decapitalize that amount. If it's not possible, you need to ask the company to ask the vendor from whom you have purchased an asset to give the value of that part at that point of time. Basis that you decapitalize. You need to identify that amount and then government reduced subsidy on agri product retrospectively, due to which receivables from government got dipped significantly, which impacted current profit. The same can be shown in the exceptional item. Refer those two para, but I don't think so it would get covered. Harshit, on very prima facie. As per today's discussion, non-funded gratuity should be shown as non-current. Yes, employee have already been there for 5 years, then what? How to calculate the current part? Employee, even if it's an organization of 10 years, 15 years, 20 years old, company is preparing financials on a going concern basis with an assumption that employee will not leave. Gratuity doesn't become payable to an employee after 5 years. It becomes payable when they leave. Hope that's answered. Hope I answered you, Ravi. I think so. We have answered. Yeah, if anything is there, and if you want me to answer, you can uh, WhatsApp me. You can send me on LinkedIn anywhere. I would answer if there is anything else.
Yes, sir. I think we have answered all the questions right now. Thank you so much, sir, for this interactive session. And you made it a point to clear all the doubts of all our participants. Thank you so much. And we will meet soon for the part 3 of this series. Thank you.
Thank you. My pleasure. Have a nice day.